Welcome to the Capital News. I am your host, Alex Karitis. Today is April 25th, 2019. Thank you so much for joining me. I hope everyone is doing well out there today. So what happened in the stock market? Well, the S&P closed down 1 point. The Dow was down 135. The NASDAQ closed up 17 points. And the Russell 2000, the small cap index, closed down 12.5 points. But that really doesn't tell the full story, does it? Because if you really look at how the markets behaved today, you had the S&P starting off in the red. It was able to stage a little bit of a comeback, and at the very end of the day, it closed in the red, albeit 1 point. Nevertheless, it did close down. There just wasn't a whole bunch of buying activity going on in the market. I mean, I thought we were supposed to be making record highs. We did. Isn't this supposed to be continuing? Aren't we in the land of euphoria? Isn't everything supposed to be peachy and rosy? I mean, what's going on here? Now, again, one day does not make a trend, but are the markets on edge? Is that what we're seeing here? Because then you have to look at the Dow, which was entirely in the red all day. It opened in the negative, and it stayed there. Now, of course, it was a lot lower. It closed down 135 points, but it was down, I believe, over 280 points at its low. So, I mean, it was able to stage a comeback again in the afternoon. Set your clock to it. We have this conversation here all the time. This is supposed to be a random walk. It's supposed to be a random occurrence in the stock market. But I mean, you can have tea time. I mean, set your clock to it. Big Ben's ready to go. I mean, look at the afternoon rally that these markets try to stage every single day, especially if the markets are trending to the downside, which was the case. NASDAQ only gained 17 points. I mean, now that is a gain of 0.2%, but nevertheless, on the backs of a strong report from Microsoft and Facebook, one would have expected a little bit of a stronger upswing in NASDAQ, but nevertheless, it opened up to the upside for the day. It did touch a little bit to the negative territory, but was primarily in the black all day, and again, closed up 17 points. Meanwhile, the Russell 2000, the small caps, they were in the red all day as well, and at one point, they lost over 1% for the day. So we're in this world of volatility with these swings that are really 1% moves. I told you guys to be on the lookout for this. Now, I really look just to see what happens on the close, but I think intraday is important as well. This, to me, something smells. Now, you know my stance here if you've been paying attention to the Capital News. For those of you who may just be joining for the first time, we are not doom and gloomers, but we have a bearish bias to these markets. There's just too many pieces of this economic puzzle that come out on a daily basis that says things are not right. Things are not great. They're not even good. Are there some aspects of the economy that might be good here and there? Sure, that's always going to be the case. Even when you have in the depths of a recession, I mean, even in the housing crisis, you had the, repossession business. Anybody who was in that business was making money hand over fist because they had a job to do. As nasty as it might have been going into homes and saying, you got to move and we got to take your stuff out of here, that's a business. So even in dark times, there's always a bright spot somewhere. Now, it doesn't mean that that's the business you might want to be in, but there's always somebody doing well somewhere, okay? But the overarching theme that we believe is we are in a bear market. We are going to be in a major bear market as these markets finally realize that, oh my goodness, everything isn't rosy, that central bankers cannot just print our way to prosperity, that federal governments the world over cannot just simply cut taxes, borrow and spend more money, and just do that, and just borrow and spend ourselves into prosperity. That's not how it works. Diminishing marginal returns are kicking in, and the only thing that's keeping it propped up, and look, that's the language that you have to use. It's even acknowledged in the markets if you pay attention to the airheads on Bloomberg and Fox Business and CNBC. They even use that terminology. Well, what's propping up the market? You don't want a market that's propped up. You want a market that finds fair value. And this market, I believe, is desperately attempting to find fair value, which is going to be a lot lower. Remember that report out by Ray Dalio and company of Bridgewater Associates, the world's largest hedge fund? They are anticipating that the United States corporations have reached peak profits, okay? Peak profit margins, I should say. What does this mean? Well, according to their report, that equities are going to take a hit, a significant hit by as much as 40%. And that takes us right where we've been saying that we likely are going to see this stock market hit a low. Okay, is it going to go back to 40% down? It very well could. I mean, that takes us to about 2016. That's where we have been predicting at a minimum the stock market is going back to 2016 levels, which would be in agreement with Ray Dalio and company. Personally, I think it's going to go a lot lower. I don't really have a dog in this hunt, so to speak. I mean, my portfolio is diversified. I have cash, I have long positions, I have short positions. I mean, you just have to be balanced because we live in the twilight zone. We live in the financial world of Oz. You have to be careful and you have to be prepared because I cannot time this. Nobody can time this. We don't know what day, what hour, what minute. So you just have to be prepared by being diversified. And if and when this major correction does occur, and it may take a while. I mean, you just look at historical data. Things don't happen like this overnight. You don't get a 40% or worse correction overnight. Now, of course, you had the 1987 occurrence, but that's extremely rare. You have these leg down, and they leg down, and they leg down, and it could take a year. It could take a couple years. But nevertheless, at the end of it, you're going to have the sell of a lifetime and buying opportunity of a lifetime because all of the companies that remain standing are going to be the survivors. Those are going to be the best of the best. They're going to be here for the long haul because they just made it through what's going to be financial and economic hell. And if they're still standing, those are the companies you want to buy up with both fists if you can. But you have to have a plan and you have to be prepared for it. And that's what we talk about here at the Capital News all the time. So don't be surprised if we, at minimum, retest the Q4 lows, which would take us down about 20% because we're making new highs again on the S&P 500 and the NASDAQ. The Russell 2000, the small caps, they're still in correction territory. They've had a quasi V-shaped recovery, but not to the extent that we have witnessed in the NASDAQ, in the S&P 500, and in the Dow. So the small caps, because they're a riskier trade compared to the larger caps, people they're more hesitant. They don't want to throw a lot of their money and a lot of their weight into the small caps because it's a riskier bet. That doesn't mean that that's not going to happen, but at least since the end of 2018 and going forward, it's only been a quasi V-shape that has not been as strong as the S&P 500's gains, the Dow, and the NASDAQ. Now, looking at oil, we are at $64.85 a barrel, so still lingering right around there. Brent, I believe, is still around $74 a barrel. Gold is now at $1,281 an ounce, so a slight gain in the gold market. Silver still is below $15 an ounce and is at $14.94. The 10-year Treasury, meanwhile, sold off a little bit, and now the yield has increased and now sits at 2.534%. Meanwhile, the VIX, the volatility index, was down about 1 percentage point for the day and now sits at 13.25. So back to the Treasury markets, because this is something where we have to pay attention to. When you have money flowing into the bond market, you're suppressing rates, right? Prices and yields are inversely related. So if you're going to have a lower yield, what does that say to some people who might have a higher risk tolerance? Well, yeah, there might be some safety with Uncle Sam in the bond market, but I'm really looking for a greater return than 2.5 percentage points. So I might go into the stock market. Well, where are you most likely going to go if you're looking for yield and some sort of security? Well, you're probably going to go into the large caps because they're the larger companies, they're well known, their trading is more highly liquid than opposed to a smaller cap stock, plus larger cap stocks are likely to pay a dividend, which if you're looking for some sort of income and a better yield, well, there are a lot of stocks out there that yield higher than 2.5% a dividend. So people are maybe flocking into the larger caps, which again goes with this V-shaped recovery, which is also consistent with the fact that you just have a quasi V-shaped recovery in the small caps, because small caps typically do not pay a dividend because they're smaller companies and they're really trying to use all of those dollars earned and to reinvest them back into the company to achieve more future growth. Okay, it makes sense. But we have to be careful when we're watching the bond market, because we here argue that interest rates are going to have a mind of their own, which means that the markets are going to say, you know what, this just isn't good enough. There's $22 trillion in debt and counting. That's the U.S. national debt. We are having a global slowdown. No ifs, ands, or buts about it. You're going to have to do better than 2.5%, Uncle Sam. And so people are going to say, all right, we're going to start selling. And those yields are going to go way up. And a lot of things, especially mortgages, are tied to the 10-year. So if you have a 10-year that's now at 3.5%, maybe even 4% because the market has a mind of its own and these interest rates take on a mind of their own, well, guess what's going to happen to the economy? Okay, it's just going to freeze. People are going to freeze. People aren't going to go out and buy homes because there probably at that time still hasn't been any type of major correction in the prices. So people are going to say, well, I still have expensive homes and now it's costing me more on a monthly basis because the interest rates have just gone up significantly. And just going up a percent or two is a big move in this market. That tells you how fragile this economy is, and that tells you that we are not in the midst of a great economic miracle, because if we were, an increase in interest rates of 1-2 percentage points shouldn't faze you. But it would. It would topple this economy. Now, the economy needs toppled because there's so much malinvestment. That's what we're talking about here. This bubble is everywhere. It's in the bond market. It's in the corporate bond market. It's in the stock market. It's, again, in the real estate market. It is everywhere. There's no escape this time. That's the problem. There isn't mommy and daddy government that's going to be able to come to the rescue and bail out the big banks this time, or some major corporations, because the government is likely to be in big trouble this time. So who's Uncle Sam going to save? He's going to save his own rear end. He's not going to save you. He's not going to save the big banks again. Of course, if he does save somebody, it's going to be the big banks. But I don't think the political will be there because, 08, 09 was supposed to be a once-in-a-lifetime event. If another such event occurs within a decade of that, well, it's not once in a lifetime, is it? It's going to be too fresh in the people's memories, and politically speaking, I just don't think that the government's going to be able to get away with it. The other thing, again, I don't think the government will get away with this, but if the government's looking for money, where are they going to find it? Well, they're going to go into your retirement account. They might go into Social Security fund. They might go into Medicare, Medicaid. They might go into your personal savings account or retirement accounts, because that's where the money is. So if you know what hits the fan and the government's scrambling and they want to do more bailouts or bail-ins, which is what that would be if they actually go after your money, we're in trouble, folks. Now, I don't think that's going to happen because of the politics, but that has happened elsewhere in the world. Remember Cyprus not too many years ago when they had their little financial crisis and a whole bunch of banking issues, and they were putting restraints and restrictions on how much people could take out of the ATM, and there was some bail-in situation over there. That's a completely different political process. It's highly unlikely to happen here, but it will cross the minds of people in government because they're going to be looking for money, and that's where it is. Because I don't know how much of an appetite there will be for further money printing. Again, of course, the governments are going to say, well, yeah, that's fine, print money, because to them that's the solution. Of course, that's the problem. So where's the appetite going to be, politically speaking, to do such a thing? We're going to find out probably within a couple years, so buckle up. Now, one of the things I want to talk about today are companies that have been around or have actually hit the $1 trillion market cap. This is an outrageous valuation, and this just goes to the euphoria that we are existing in. This goes to the financial world of Oz in which we live. You guys understand how much $1 trillion is? It's 1,000 billions. It's 1 million millions. It is 1 million millions. That's how big $1 trillion is. It's very hard to fathom that number. I don't care who you are, myself included. It's an extremely large number. And you're talking about a handful of companies that have hit it or are very close to it, okay? I mean, Microsoft, given their earnings beat this week, they clipped $1 trillion market cap. Now, I mean, they're a little bit below it today, but given how the stock's trading, it could be right back up there. So you have the likes of Microsoft, Apple, and Amazon that are in the $900+ billion market cap. So depending on how the stock moves in a day, it could hit $1 trillion. Google, or Alphabet as its parent company is known, $860 billion. Okay, but still up there. Okay. For reference, let's look at ExxonMobil, largest oil company, right? $348 billion. $348 billion. Not even close to where these guys are. Facebook, $550 billion. Facebook has a larger market cap than ExxonMobil. Facebook's been around for a decade. What do? You take photos, you say hello to some family, you tell people you're going out to dinner, then they can come and rob your house. I mean, these types of things. I mean, they collect your data, they're spying on you. I mean, you have some advertisements, this, that, and the other. But I mean, Facebook, $550 billion market cap. Meanwhile, ExxonMobil, a company that's been around for 100 years, supplies the world with energy that it needs and uses on a daily basis, second by second, has a $348 billion market cap. Is something not right here? Is something wrong? What's going on? Tesla, just because these are the darlings of Wall Street, right? These are the names that everybody wants to talk about on the financial mainstream media. Tesla, $43 billion, not even close. But what about General Motors? $55 billion, so only slightly longer. Again, General Motors has been around for 100 years, sells cars all over the world, has a business model, has proven to succeed. Now, of course, 0809 was another story. They got bailed out, but nevertheless, $55 billion. Meanwhile, Tesla, who's only been around a decade or so, $43 billion. What's the euphoria? Where's the rationale for this? Meanwhile, again, just for context, Ford is at $37.5 billion. So Tesla is worth more than Ford. You can't make this stuff up. And Ford didn't need a bailout 10 years ago. They were the only auto company in the country that didn't need a bailout. I mean, this is unbelievable. I mean, you can't make this stuff up. So my question to you guys, basically, is this sustainable? Is this the era of euphoria? We talk about the melt-up, right? We've been having that discussion recently with Larry Fink, the CEO of BlackRock, a major investment firm, saying that there could be a melt-up in the stock market because there's a lot of cash sitting on the sidelines. Well, couldn't we also already be in the midst of a melt-up? If we are in a bear market, this has been a V-shaped recovery. I mean, we're seeing gains of 20, 25, 30% plus in some individual stocks. I mean, that's sort of the definition of a melt-up. Could it go further if that cash decides to come in and play ball? Sure, it could. So it could rally even further to the upside. But that's really sort of the death cross, in my opinion. That's the death blow because now you got all the suckers in. And once all the suckers are in, then you start to pull their feet out from under them. That's it. Game over. And to me, the risk-reward just isn't worth it. Hanging on a prayer that people happen to put their money in the market just because it's got to go somewhere, that ain't good enough for me. I mean, maybe it's good enough for you, and good luck to you, but it's not for me. Again, I have some long positions, but I'm just going to let them do their thing. What happens, happens. It's just not worth putting a whole bunch of more capital to work to maybe gain another 5, 10%. And it could be more, but to me, that's my risk tolerance. You have to understand yourself. You have to know yourself and what you're willing to tolerate before you make a trade, before you get committed to something in there. So just be careful. Again, have a plan. And if you're in this market, have a stomach for volatility because we're going to see more and more volatility. We're just going to because these markets are on edge. You have some good numbers coming out with these earnings reports. Now, of course, that's the game that's being played. We've had this discussion as well where you have analysts come out and they overshot to the downside how companies were going to perform. So they had a low hurdle to jump. And now it's a lot easier for them to say, oh, look, we beat expectations on earnings and revenue. And that's what we're seeing. Now, that's not across the board, but it's enough in some of these bigger names. Again, we live in a marketplace that is just clinging to hope. So if you have some of these big names come out and say everything's rosy, here we go. We're going to rally. And that's exactly what we had earlier in the week where we had this S&P 500 and NASDAQ making new all-time highs. So nothing's changing. But the question still remains, are these valuations sustainable? Can you have trillion-dollar companies? I mean, there isn't even any model that exists out there because we've never lived in a world of trillion-dollar companies. But this is what happens when you have money for nothing. This is when you print funny money. This is exactly what happens. So for these guys simply to go back to where they were, I mean, you're going to talk about 20% decline easily, if you think that maybe ExxonMobil is more in the wheelhouse. That's $348 billion, remember? So you're talking, just to get back down there, you're talking a $600 billion swing on some of these companies. $600 billion. That's 2/3. That's a 60% decline if you were to say that, well, ExxonMobil is sort of the base case. Now, I don't know if that's true or not. Again, what study is out there, because we've never lived in a world of trillion-dollar companies. So this is very scary. It's uncharted territory, because they got up that high, they can come down just as quickly, believe you me. And that's what we saw in the fourth quarter of 2018. So it's just something to ask yourself. Does that make sense, and is it sustainable? I don't believe that it is, because these are the same companies that led this market to the upside. It will most likely be the same companies that lead it to the downside. Now, one of the main drivers for the Dow being in the red today was the industrial company 3M, a lot of household products. I'm sure a lot of you have them in your homes. 3M missed. They missed, okay? So, and in fact, the shares in 3M posted their biggest one-day drop in decades after the company reported first quarter results that fell short of Wall Street projections. The company also announced plans to cut 2,000 jobs worldwide as part of a restructuring due to a slower than expected 2019. Okay, it continues. Of the 5 units, only the healthcare group saw an increase in sales, albeit a modest 0.3% uptick. The other 4 units, industrial, safety and graphics, electronics and energy, and consumer, saw declines ranging from 1.9% to 11.8%. The company said effective April 1st, it had restructured to 4 units, safety and industrial, transportation and electronics, healthcare and consumer. So it dropped the energy part of it. But nevertheless, you're talking a 13%, near 13% decline in the share price of 3M today alone, which is obviously a part of the Dow Jones Industrial Average, which is why you saw such a decline in the Dow today. What's going to happen tomorrow? I mean, forward guidance isn't great either. I mean, it's just not. They lowered their yearly earnings guidance. The company now foresees its 2019 adjusted earnings in a range of 9.25 to 9.75 per share. Its prior outlook was for $10.45 to $10.90 per share, so quite the drop in forward guidance. This is from a major industrial company, global. Is this a harbinger? Is this the real news? Is this what we have been talking about here? Because it's going to come a time, people, where this market catches up to reality, or reality catches up to the market, however you want to put it. Because we live in a financial world of Oz. $1 trillion market caps. Is it sustainable? I don't think it is, but I would like to hear what your opinions are on that. And then lastly, before we sign off here for the day, just a couple other talking points. Recent inflation figures from Australia came in much lower than expected. It was at 1.3%. So the Australian dollar took a beating, because now the expectations are that the Reserve Bank of Australia is going to be more likely to take a wait-and-see approach, if not cut interest rates to record lows in the land down under, because now, with inflation reading 1.3%, they have some wiggle room should they decide to use it to say, okay, we're going to lower interest rates. 1.3% again, we here in the United States look for about a 2% inflation rate. The Australians are looking more for like a 2 to 3%. They're willing to tolerate 3%, maybe even a little above that, depending on what's going on. So they got a lot of wiggle room here if they want to use this as an excuse. But nevertheless, this is the same story. This is the same thing. This is giving cover to yet another central bank to say, okay, we're going to do wait and see what happens. Wonder what that means. Likewise, to our friendly neighbors to the north, the Canadians, well, they had their recent meeting up there, and the central bank said, well, things aren't as great as we thought they were going to be, so we're also going to be in wait-and-see mode. So the Canadian dollar, the loonie, that's what it's called for those of you who may not be aware of that, the name for the Canadian dollar is known as the loonie. Looney Tunes, everybody's a lunatic, get used to it. So that's a good name for it. And they lowered their expectations, their forecasts for 2019 GDP. So that gives them wiggle room to lower their interest rates if they want to, because they were on the same path as the U.S., folks. The central bankers of Canada were basically saying, you know what, everything's fine, and we're going to start to increase interest rates. And then lo and behold, there's some bad news that comes out, and boom, now it's wait and see, and they're lowering their forecasts for 2019. Now, of course, they're still sort of clinging to hope that the second half of 2019 will pick up, and if that's the case, well, then maybe we'll go back to increasing interest rates. That's a bunch of bull. I mean, that ain't going to happen. And remember our recent discussion only, I don't know, was it last week or whatever, in regards to Stephen Eisman, the one of the leading, I guess, stars, you could say, of the movie The Big Short. Character was based off of him, saying that there's some major issues with some Canadian banks, and he's expecting at least a 20% decline in some major banking companies in Canada. So if that happens to live out, if that comes true, what do you think the Central Bank of Canada is going to do? Do you think they're going to increase interest rates? No way. They're going to lower them just like everybody else. And stay tuned, because the Federal Reserve is meeting next week, and we're going to see what they're going to do. Is it going to be wait and see? Are they going to have a dovish tone? Are they going to have a hawkish tone? What are they going to do? It's going to be very interesting to see what transpires. All I know is trillion-dollar market valuations are ridiculous and unsustainable. But I want to hear your thoughts on that. And I honestly believe that these markets are on edge. I just don't think that they know what to do. And because they don't know what to do, I think they have to correct to fair market value. But are the central banks going to let them do it? So far, the central banks have been able to keep them propped up. I think there's going to come a day where they're not going to be able to. So stay tuned. That's what I'm here for. Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you as always. Please like, share, subscribe, get the word out. Leave your comments. I would love to hear from you. This is the Capital News. I am Alex Koritis. Godspeed.